Wars breaking out, oil smashes through $100 a barrel, inflation is spiking, and now, for the first time in modern history, both of the Middle East major shipping choke points are simultaneously under threat of closure. If you own silver and gold and you do not understand what's happening right now, this video is for you. By the end of it, you're going to get a full understanding of the chain reaction and why none of this changes a single thing about the long game. Let's get into it. Let's start with what's actually happening. On February 28th, the US and Israelis launched attacks on Iran. Within 48 hours, the Strait of Hormuz, which is the world's most critical oil choke point through which 20% of the global daily oil supply passes, effectively closed. Every major shipping carrier suspended transit, and over 150 tankers anchored outside the strait rather than risk an attack. Oil was sitting around $70 a barrel before the war. It exploded past $100 within days, came back down, and is now again near $100. That is a 40% move driven entirely by geopolitics. And on top of that, the Federal Reserve just wrapped up its March meeting today. Rates held firm, no cuts. Powell just stepped off that podium and confirmed what markets already feared. We're going to get into exactly what he said and what it means for your stack in a moment, but first I need to tell you about the second choke point because this is where the story gets significantly more serious, and I don't think anyone else is covering it at the moment. There's a second strait you need to know about right now. It's called the Strait of Mendeb, and most people have never heard of it nor can find it on a map. It connects the Red Sea to the Gulf of Aden, and it's the gateway to the Suez Canal. Roughly 30% of the world's oil passes through it. Everything shipping from Asia to Europe goes through it. And as of March 14th, 4 days ago, Yemen's Houthis movement declared that they are calling Hour Zero. Their fingers are on the trigger, and they are fully aligned with Iran, and they have announced they are prepared to declare a full naval blockade. Here's the critical detail. When Iran closed the Strait of Hormuz, Saudi Arabia tried to reroute its oil exports through its east-west pipeline to the Red Sea port of Yanbu, which was a smart move, except that route goes directly through the Strait of Mandeb. So if the Houthis closing that strait would effectively cut off Saudi Arabia's only remaining export route. 75% of the Saudi's crude exports go to the Asian market. Every single one of those tankers has to pass the strait twice, once to load the oil and once to deliver it. If the Houthis decide to close that strait, Saudi oil does not move. And the shipping giants already know it. Many of them have already paused all trans-Suez sailing. MSC has paused all bookings for the entire Middle East region and is avoiding both straits simultaneously. Insurance companies are also canceling coverage altogether. Right now, we are in the middle of a situation that has never happened in modern history. Both of the Middle East major maritime corridors are simultaneously either closed or on the verge of closure. The double choke point scenario, and every day this war continues, that second closure becomes more likely. What does a double choke point mean for the silver and gold market? Every additional supply disruption, every additional inflation shock, every additional reminder that the global financial system is held together by a few narrow waterways controlled by geopolitical forces that no one can predict or protect. That is the long-term argument for holding real, physical, tangible assets outside of the system. Keep that in mind as we walk through the rest of the chain reaction. Alright guys, so here is the chain reaction in plain English. The Strait of Hormuz is closed, the Strait of Mendeb is under threat, oil hit over $100 a barrel at one point today, and Brent crude topped 109 a barrel. Everything that moves through the economy gets more expensive. Fuel, transportation, manufacturing, food, that is inflation. And when inflation spikes, the Fed cannot cut interest rates, cannot ease, and today they confirmed it. The Fed just held rates at 3.5 to 3.75%, unchanged for the second straight meeting. No cut, no relief, and here's what that means. It makes it worse. The Fed just raised its own inflation forecast for 2026 from 2.5 all the way up to 2.7. They are telling you directly that they expect inflation to stay hot and there's nothing they can do about it while oil is at 100 or above. 6 weeks ago, the markets were expecting multiple rate cuts starting mid-year. Now, the CME FedWatch tool shows no realistic chance of cuts until at least December. And some analysts are saying and calling for zero cuts for all of 26. The stock market felt it immediately today. The S&P 500 dropped almost a percent, and the Nasdaq also almost dropped to 1%, and the Dow fell nearly 450 points right after the decision. The 10-year Treasury is currently sitting at 4.23%, and the Producers Price Index for February came in at 0.7%, more than double than the economists predicted. They were expecting a 0.3. Hot inflation, frozen rates, falling stocks, and oil that is touching $109 today. That is the environment silver is trading in right now. Gas is hitting its highest levels since 2023, with crude touching $109 today before settling back. Transportation costs are rising, manufacturing costs are rising, and the PPI inflation print for February came in at more than double what economists expected. With the Houthis sitting with their finger on the trigger of a second choke point that would make all of this significantly worse, the Fed looked at all of that today and did exactly what markets expected: held rates, raised the inflation forecast, and give no clear signal on when cuts are coming. That's the confirmation as of today. So why do high interest rates hurt silver specifically? Well, there's two reasons, and I want to make both of them crystal clear. First off, when rates stay high, the US dollar stays strong. A strong dollar makes silver more expensive for international buyers because they have to convert their weaker currency into the stronger dollars just to buy it, which causes less international demand, meaning there's lower prices on the spot market. The second reason is when rates are high, you can actually earn money just sitting in cash. A 10-year US Treasury is paying over 4% right now, which is guaranteed. Silver pays you nothing to hold it. So a lot of short-term traders ask themselves, why hold silver earning zero when I can earn 4 to 5% guaranteed? They sell, and that's the selling pressure that you're seeing exactly today on the charts. Silver is sitting at $77.70 as of this morning, down over $3 since yesterday, and down from over $100 at its peak. Paper traders are exiting, ETF outflows are happening, future positions are being unwound. This is a rate driven sell off in real time. But none of that matters, and I'm going to tell you why. Here's what I want every stacker watching this to understand. Everything I just described, the rate fears, the dollar strengthening, the ETF outflow, the future selling, all of it is done on the paper market. Not one single bit of it removes an ounce of physical metal from anyone's safe. 2026 is the sixth consecutive year that the global silver markets have run a supply deficit. 6 years in a row where the world consumed more silver than it produced. The physical silver market is now the primary bottleneck for the world's most critical emerging technologies. Everything from solar panels, electric cars, AI data centers, silver is in all of it. It is one of the best conductors of electricity on the planet, and there's no substitute that does not sacrifice efficiency. Elon Musk is on record today warning that silver is becoming a critical fraction point for EVs scaling. The war is disrupting global supply chains. The double choke point scenario, if it materializes, makes silver supply even tighter because mining operations, shipping, and processing all depends on global trade routes that are currently under direct threat. The paper price went down this week. The physical fundamentals got stronger. You cannot get a margin call on a coin in your safe. You cannot print more silver. The Houthis closing the strait does not create a single additional ounce. Remember that every time you see a red day on the charts. So I want to get back to the price of silver here. Even with silver being down $3 today and it coming down from its all-time highs, with the situation with the Houthis having their finger on the trigger, the Fed holding rates, and paper traders being nervous, even with all that, silver is still up more than $43 an ounce over the past 12 months. Look at that number on the screen. I started buying silver at 15 an ounce, and I kept buying through 30, 50, 80, and even bought a bunch at over 100 on this current rally. Every single step of the way, there was a headline telling me to stop, a rate hike, a dollar surge, a price crash, or an analyst calling the rally over. I ignored every single one, and I kept stacking, not because I knew where the price is going. No one ever does. But because I understood what I was holding. Real money, a finite supply, and thousands of years in value. Something no government can print, no Fed can debase, and no shipping disruption can create more of. The world right now is staring at a potential double choke point that has never happened before in modern history. Two straits, 30% of the world's seaborne oil, the entire Asia to Europe trade route, all of it simultaneously closed. And people are asking whether to sell their silver because of the spot price dropped $3. I want you to think about that. The long game is the only game worth playing. 11 years in, and I have absolutely zero regrets, and I will be stacking through whatever this war brings next. Alright guys, so that's the full picture here. We have oil at over 100, the Houthis are doubling down under choke point threat, inflation is hot, and the Fed decided to hold rates firm. We also figured out why rates hurt silver short term, and why none of it changes anything for us physical stackers playing the long game. Now you understand the situation better than 90% of the people out there. But lastly, I want to know, what are you guys doing if you're stacked this week? Are you going to buy the dip? Are you holding? Or are you nervous about the Houthi situation? Drop it in the comments. I read every single one of them, and I genuinely want to know what you guys are thinking. And don't forget, hit the subscribe, turn on notifications. I go live multiple times a week. And right now, with both choke points under threat and the Fed speaking today, you don't want to miss it. Thanks for watching, and stack on.